Sure hope we weren't
Are we?
recording.
Kelvin, you found what you needed to find, right? You're good to go? Everybody good?
I think so. It's going to be a really...
Oh, were we looking for something?
I thought he was trying to look
I was
something
looking up the shared equity
that's
thing.
cool. He never
no
knows
one
what's
does
going
it.
on.
11 minutes. Stand by. Segment 3.
No one does it.
And now, we return to the purveyors of real estate knowledge, your Real Estate Chalk Talk.
Welcome back to the program. This is your Real Estate Chalk Talk with the Hittner Group, HITTNER Group.com, HittnerGroup.com, all one word, 612-627-8000. That's 612-627-8000. That's the number you see on all the signs around town, both of them. That are on houses for sale. There's no inventory out there. 612-627-8000.
It's all over. It's all over.
It's all
in
over.
every yard.
You know how you get a listing? Or you know how you get a call? This is a good way to get a call. I'm trying this method. Because you're trying to get listings, right? Just go jam your temporary for sale sign in front of the house. Pick a house you'd like to sell and go put the for sale sign in, step-in sign.
Do you remember when our old assistant installed a sign
on the
for
wrong
one
house?
of my listings?
Yes.
On the wrong house?
On the wrong house.
It was on an entire street over, and we get just this mad call from a homeowner.
Oh my gosh.
And
You
Senior was
imagine?
like, well, did you ask them if they just wanted to leave it there? Maybe they wanted to sell.
Maybe it was a God thing.
That's a good, you get a call.
Sure.
Right? Calvin's always complaining.
Oh, whoops, sorry about that.
Yeah.
Well, anyhow, it's there.
As long as I got you on the phone, you've been thinking of making a move for now or sometime this fall?
We can just leave the sign or drape something over it
That's
until you're
right.
ready.
All right, so
Oh, that's funny.
with the environment that we're in, let's face it, it's a high cost. Everything's expensive. Groceries are expensive. Everything's expensive. So people are trying to figure out how to get their costs down. You know, buying off-brand products, store brand products as opposed to national branded products, and doing this and going to bulk stations. All with real estate, there's lots of. I'm amazed at the creativity of people and companies who are trying to figure a way to make it more affordable. I remember back in the late 80s when rates were at 15%.
Mm-hmm.
The solution there was 40-year mortgage. Well, they had 40 and 50-year mortgages in Japan, so maybe we can do a 40-year mortgage here, which means that on your first 5 years of your mortgage life, you've paid your principal down by $1.99.
Right.
It's just
Might as well be renting.
You might as well be renting. And it got the payment down because there was essentially no principal payment being made.
Yeah, you're just stretching that payment, the payment or the principal payment back over the 40 years versus 30. So
right.
Another 120 months.
Exactly. Pushing it back to that last 120. Then you've got, I started seeing some articles this week about interest-only loans again. IO loans. They were very popular for a long time. Interest only.
I priced one out this week for somebody to just see the difference in the payment, and on a like 400, the loan amount was about 450, and it changed the payment by about 400, just under $500 a month.
Okay.
And it was interest only. You pay for it, right?
You're
but
paying
it's
for the
interest
use
only.
of the money,
Yeah.
and then the thought process is what? And when rates come down, you'll refi.
Then you refinance them into a long-term solution because your interest only is a 5-year, 7-year. So, but so it's about the same rate. About the same rate where rates are right now, but your interest only.
Now, is it possible to do a buy down on an interest only?
Yep,
it is.
You can. Yep, we can go up to 2 points under.
Okay, so that could be very attractive to somebody, especially if you're like you move a lot. If you're a military or a job where you're in for a few years and then you're out, that could be a very attractive option and get you in at a very attractive rate. I mean, you're 2 points down. I mean,
Yep. You can, it's a good option. It's just
I think it's better for more long-term solutions, though. I mean, when you're looking out long-term, like the guy that moves around a lot, even right now, if I have somebody that bought a house a couple years ago, things were pretty crazy in the market, and now they want to move right now.
Right.
It's like we haven't really seen a lot of movement in terms of like
equity position.
A lot of appreciation when
Right.
you're talking about the overall cost of buying and selling real estate. So
You'd probably be lucky if you've absorbed the premium that you paid on the house.
Right. So there was a bit of a premium,
Yeah.
and then you have more of a reality situation where you're at, plus the overall cost of buying and selling the piece of property.
Yep.
I would be careful on somebody that like moves around a bunch and really, suggesting hard on an interest-only situation. I'd rather be more conservative on like, let's drop the sales price maybe $50,000 or something and work on the payment that way. Meaning that's your budget. It should be a little bit lighter. I mean, everybody's budget is.
Yep.
When you're out shopping for a house and you're like, 600,000 is where it's at. It could have been 800 a couple years ago.
Yep.
Right now, because of where rates are, they've doubled. You might want to look at just adjusting the budget, which most people have. So I think the pricing too. I mean, for these entry-level homes, I don't think it's going to significantly change, right? It's not going to go split-level homes in XYZ suburb or your 50s Rambler in XYZ first-ring suburb, Roseville, Richfield, Bloomington, Golden Valley. Golden Valley is expensive, frankly.
Yeah, it is. It's a nice suburb.
For those properties to be 330 to 380 easy. 330 would be a low end. 380, it's probably gussied up a little bit, and even into the 400s low if they're really nice.
Right.
And then your split level homes being like 375 to 450, depending on the properties. To buy a home like that, median sales price basically in the Twin Cities, you got to bring in $6 figures to make it really make sense. And then even at that, you're still living pretty conservatively, meaning you don't have a $700 a month car payment that you're paying for times two. Your kids aren't going to private school. You're not eating out every day or taking lavish vacations, and that's just bare bones to get you in.
The other thing that people are doing, and we've been doing this for a very long time as well, just that now it's going to start, I think, being asked more, is the government, the bond programs. Different bond programs. MAHAPA, they're looking at city programs, because a lot of cities have money set aside because they've got particular neighborhoods that they want to help people get into and so forth and so on. But aren't they're always capped at some kind of a number?
It's typically 80% of AMI, your area median income. So you're talking high $90,000 is probably where you have to be income wise.
Okay, in order to qualify.
A larger family would be able to get over $100,000.
Okay,
but there are a ton of programs. We have our website's wonderful on finding those programs. You just put in the location, it brings up every program that's available, and then we just look, see if you fit in the box. The whole thing is it's fitting in that box, right? You make too much money, the home is worth too much or not enough, and
credit scores matter.
Everything matters. Okay. So you got to fit in the box, but there are a lot of programs out there right now. And we just rolled out FHA. They're coming out with a 0% down program. We have a 1% down now in FHA program as well. So if people want to get into a home, they can get into a home, but it's just the rate.
I think it's the budget, monthly budget part of
it.
Because it's not always like, I can't come up with $12,000 for the down payment.
Right.
A lot of times people have the down payment. It's just like, because
your
monthly payment's $3,800 or $3,500.
You got to do the math on this deal, right? Minimum down, which is where all these people are at. You can't make over this much, and now rates are 8%.
Right.
So now, you don't qualify.
Right.
So put in your income, put in the current interest rate, right? And then your home has to be in this range. It just won't work. You're not.
But you have a calculator, online calculator. They can plug their numbers in.
Oh, it's super. Yeah, just call me. It's really
that's the easiest.
It's really good. So we have a lot of programs.
Another thing that's been around for a while that when rates are at 3.5%, you don't pay any attention to these programs. There's some religious affiliation programs where the lending institution actually takes an equity position in the property. And they've been around for a long time because of their religion. They can't pay interest or be paid interest, and so then they take it out as an equity share. Well, now there's programs out there that was just approved this week by Freddie and Fannie, shared equity programs where actually you can sell some of the equity in your house, and another company can buy that equity and own it. and ride the appreciation wave of that property
Mm-hmm.
and trade it, on like any other asset, and you can buy that asset back if you choose to at a later date. So you can use that, and that was always not. It was been around for a while. It was at 100% of the minimum, whatever the wage cap was.
Yep.
They made that now. It's 200%. So they've really opened it up. They're trying, open it up and make that available. Whether that'll take off or not, I don't know if I like the idea of a corporation owning
Part of the equity in your home.
20% of the equity in my home. I don't
Now,
know.
is there restrictions on that? That'd be interesting to deep dive.
See what the box is to fit in on that deal.
Right. Just to kind of see whether or not I would never let somebody else have equity in my
Well,
property.
I wouldn't
Why
either.
would
But
you do that?
at the same point, when you take a second mortgage out and a first mortgage out, they have a claim on the equity in that house.
Right.
Anyhow, they already have their hooks into the house. So
Yeah.
this is just a different way to do it, where there is no interest, there is no payment, and they're gambling that the house is going to appreciate.
It's like the silent second.
It is like a silent second, and they're gambling that the home is going to appreciate. It's like the insurance company. They got better actuaries than I do, so I'm gambling that they probably know more about it than I do. And if they think that the market's going to go up and they're going to profit from this, then it's probably not a bad bet all the way around. Creative ways that people are trying to figure out how to make it more affordable.
Yeah. for
We'll
sure.
be right back with the money segment of the program after these messages.